And then in October 1929, it came all crashing down.
Oh, the infamous stock market crash. Typically, SEC was formed to restore the confidence in the system.
The material financial information with all investors at the same time, and that was to eliminate insider advantages.
Today's episode is sponsored by TaiPai. TaiPai revolutionizes enterprise application development, turning business ideas into robust, data, and AI-driven solutions. With TaiPai's drag-and-drop features providing intuitive user interfaces coupled with what-if scenario capabilities, TaiPai empowers business analysts to make insightful decisions that are fundamental to drive today's dynamic business.
Jay, who's a seasoned expert in systems, risk management, accounting, and finance. As a founder of Appra, a top NetSuite consulting firm serving over 150 clients, Jay brings unmatched insights into business transformation. He's a chartered accountant, a CPA, and CISA, so he's a trusted mentor to startups and established companies alike. Currently, Jay is exploring the game-changing potential of AI in finance with a sharp focus on revolutionizing the B2B purchasing process.
Thanks, Norm. Thanks for including me in this opportunity to talk through Osumi and reporting. To me, this is something which is very close to my heart because, behind every market crash, a correction or a financial scandal, there's always a lesson in transparency and trust, right? And SEC plays a pivotal role. Sometimes it feels like they're playing a losing game, but sometimes they catch it beforehand. For all of those that we see as losing, there are hundreds and thousands of those that they're winning that we don't get to see that. And, looking through that series of, the SECs and how they are doing it, it's going to be a completely an interesting conversation. I'm looking forward towards it.
Well, that's awesome. I agree with you, Jay. And, these discussions that we're having, aren't just history lessons. The reporting norms intends to cover everything from, the essentials in financial reporting and governance to complexities of IPO strategies and regulatory updates, latest trends that transform the industry. And so what we'll feature are experts like yourself offering real world insights and actionable advice that you've experienced through the many years of your own experience, which is decades and decades, right?
Yes. You aim to be right there.
Right. So whether you're a professional or just fascinated by the world of finance, our goal on these sessions are to just spark your curiosity, deepen understanding, and help you navigate the ever-changing landscape of accounting and business. So that's our intent here.
So looking forward, let's take the big step back. Let's talk about the origin of SEC itself. I'm assuming it's 1920s. What helped? What was the reason why SEC was created, Norm?
It's a great question, Jay. When we think about what was happening in the 1920s, it's hard to believe that that's just about 100 years ago. But it was going through unprecedented economic growth. The stock markets were booming, but all of it was really on some shaky foundations. And that's because there was really little to no regulation. There was no oversight by the government or really any formal body of oversight. So insider trading was rampant, and many companies sold their stock based on misleading or just outright false information. And then in October 1929, it came all crashing down.
Oh, the infamous stock market crash, which led to Great Depression, isn't it? Yeah. Okay.
That's exactly right, Jay. That's right. The market crash of 1929, where it just wiped out billions of dollars of wealth of people, and then the ugly Great Depression set in. after 1929. And so, and that happened because people lost trust in the markets, but Congress knew that they needed to do something. And so that's why they came up with the Securities Act of 1933. And that required companies to disclose accurate financial information. And then the next year after that, they established the Securities Exchange Act to further enforce rules and oversight of these markets.
Yeah, like typically SEC was formed to restore the confidence in the system. Otherwise, who knows what's coming out of that? Yeah.
That's exactly right, Jay. That's so true. And so one of the first major steps was that public companies were required to file regular, accurate financial reports, which really is the cornerstone of today's modern financial transparency. As we talked about earlier, the SEC has been around for about 90 years now. And so, in your view, what are some of the major rules and milestones that continue to define the SEC's role, in your opinion, Jay? What's your view on sort of the SEC's role?
If you think about it over the last 100 years, the most important, relevant, change that SEC pushed through was the Sarbanes-Oxley Act, and I think it changed the overall, looking at who is responsible for these fraud and how should the executives think about these frauds. Is this something for them to quickly make money and run away, or are they personally liable? These conversations brought it up there.
Yeah, totally agree. Was there something, that happened that triggered the Sarbanes-Oxley of 2002 that you remember back, in the early 2000s? What were there some scandals that, come to your mind? What comes to my mind?
Yeah, we all talk about Enron and WorldCom the most, right? And how Enron, apart from messing up with California and their power, they were also messing up with their financial statements, and how, Arthur Andersen went along with them on that conversation there, and WorldCom. Definitely, we can get into that details there.
Yeah. Wasn't one of the major requirements of SOX that the CEOs and CFOs, they actually have to personally certify financial statements now, right?
Yeah, correct. And based on, they just not only have to certify the financial statement, but they also have to certify on the ICFR, the internal controls related to financial reporting, to make sure that, those are in place, and they have a reasonable expectation that the numbers are, materially correct.
Yeah, no, that's exactly right.
Yeah.
So SOX definitely made companies more accountable. And I know that in your personal experience, you've had quite a bit of experience working with companies to implement SOX. Do you have, a story that you could share with us on what you did in implementing SOX at one of your companies that you worked on over the last few years?
Let me give you some nice, interesting story, right? And something which is very light, and you would think about and say, hey, this makes sense, right? So we had a company where it was a smaller company, and it grew larger, and it became a public company. The CIO was the first developer hired by the company, so he continued to be involved in development of the software, right? And here he is, the top executive of the company, is still making code changes in the system, right? So we had a conversation with him, and we were talking about how segregation of duties expects him not to do these type of changes in the system because he's in an executive role, and he wouldn't agree on it. So then we were reviewing it a little bit more thoroughly. We realized that there was obviously a code issue that had happened, right? And he had pushed in a code which was wrongly calculating the fees to be charged to the customers, right? So this became a huge issue, and then we went back to him and said, see, here is a classic example of why internal controls are failing, because you're taking this high-handedness of changing everything you want with no controls over you, right? And he accepted it, and he redeemed it, and that's a good example of how these controls are so relevant to a company.
Wow, that's an interesting story. So, you had to go back to the CEO, was it, or the CISO?
CIO,
Right.
yeah, and tell him it changes, yeah.
You had to tell them to implement some sort of controls around change of the code.
Right.
Okay. Well, that's a great example. Um, and so, when I think about SOX and some of the other important laws that have come out of the SEC over the last, several years, another one that comes to my mind is Regulation FD, sometimes referred to as the Regulation of Fair Disclosure. That one came out in 2000, and essentially what that one required was companies needed to share the material financial information with all investors at the same time, and that was to eliminate insider advantages, which was part of the problem, in the crash of 1929. But it's interesting that 80 years after that, they had to come up with something called fair disclosure, but essentially gave access to material information to the institutional investors as well as the public, all at the same time, so that no one had any advantages over anybody else.
I also think it's because of the communication changes that happened between 1920s versus 2000. Now we have these emails, the websites, the phone. Before it used to be like printed mail, so it wasn't such big impact, right? And
Yeah, that's a great point, Jay.
Yeah.
So many technological changes definitely have happened since 1929. But what's interesting that came out of Regulation FD is this concept of materiality. And what they tried to do is to define what does material mean. And essentially what they said was that something is going to be considered material if there is a substantial likelihood that a reasonable investor would consider it important in making an investment decision. So you can see that that rule is in and of itself not quantifiable per se, that it requires some judgment.
Absolutely.
But you know what I mean? It does require that judgment on materiality, right?
Right. US GAAP does a good job of trying to reduce subjectivity in all our discussions. But yes, this is a good area where subjectivity is so important. But why don't you walk us through some examples of this FD rules and how it's impacting? The recent Macy's one would be a great one, Norm, to go through.
Oh yeah, so that's a great example, Jay. Yeah, so very recently, just earlier this month, December 11th, 2024, Macy's issued their Form 8K, and in future sessions we'll talk more about the Form 8K. But this disclosure basically said that that they had uncovered an accounting issue. And let me just kind of read it verbatim from the 8K itself, because I think it's important. So it basically says, as previously disclosed during the preparation of the company's unaudited, condensed, consolidated financial statements for the fiscal quarter ended November 2nd, 2024, the company identified an issue related to delivery expenses in one of its accrual accounts. The company consequently initiated an independent investigation, which has now been completed, and following its analysis, determined that there was no material impact to financial results for any historical, annual, or interim period. As a result of the independent investigation and forensic analysis, the company identified that a single employee with responsibility for small package delivery expense accounting, for small package delivery expense accounting, they intentionally made an erroneous accounting accrual entries to hide approximately $150 million. Amazing, isn't it? Of cumulative delivery expenses from the fourth quarter of 2021 through the third quarter of 2024. So that was the October quarter of 2024.
It's interesting. It's not even a fraud. It's an erroneous entry, maybe to show better results. But why would an individual employee do it? And why would there not be enough ICFR in the organization not to have caught this particular type of an issue? Right.
That's a great point. And so this Macy's example is a great one where it really was not material, but it was enough of a accounting issue that the company felt it was important for investors to know about this particular accounting issue, even though it was immaterial.
Yeah.
And in their 8K, they do show an analysis that kind of proves out that it wasn't material. Basically in the P&L, I think it really just is a misclassification of the expense between cost of goods sold and SG&A.
Yeah.
So it doesn't necessarily change the P&L per se. And then they talk about not impacting cash flows and the vendor expenses and stuff. But like you said, though, it does raise questions about how management is really overseeing the back office and how one employee could intentionally account for these recurring transactions in an incorrect manner over a long period of time, right? It's amazing.
Yeah, and you like such a classification, regular P&L doesn't make a difference. But when we are doing management assessment and we are looking at gross profit of the company, suddenly the numbers have now changed, right? And then it's interesting conversation.
That's exactly right.
Yeah, perfect. Let's talk about FCPA and how it goes down. I think that's another big change that happened, right? So
yeah, that's a great example of some of the evolution of the SEC over the last several years. And this one, the FCPA, or basically the Foreign Corrupt Practices Act, this was passed back in 1977. So this is almost 50 years ago.
Yeah.
Essentially, that was passed.
Yeah, it's still very relevant. Last month or this month, we had a big acquisition from SEC on the Adani companies, from India, right? I think where, along with Mr. Adani, two other people were accused of, bribing Indian states to buy energy at a higher price than, what the market rates are, right? I think it's a very, very sensitive topic given, the geographies involved and the pervasiveness of Adani's businesses in India and the influence that has in that geography. But I think I know of that FCPA is the most stringent regulation that SEC would want to be enforcing it, and we've got these examples from IBM and so many other places where they've had these issues before.
That's exactly right. And with the Adani case, they're a foreign issuer. They're a foreign private issuer, so they don't file a 10K or a 10Q per se, but they do file foreign issue reports like 6Ks and 20Fs. But since they are this company, I think was called Azure Energy Company, is a company that was listed on the NYSE, it still fell under the SEC enforcement rules. So FCPA, the alleged bribery of the management of Azure to Indian officials, becomes relevant because of the fact that they're listed on the NYSE.
Awesome. Do we want to switch topic to PSLR?
Sure. I think the Adani example is a great one for FCPA. I think another one that is worth mentioning is the Private Securities Litigation Reform Act, or PSLAR. This one came out in 1995, and essentially it was intended to reduce frivolous securities lawsuits while ensuring that really legitimate claims could still proceed. So it try to strike a balance between investor protection and minimizing legal abuses, which were kind of happening in the early 90s.
Right. I think there was some very high profile cases on that. We should probably discuss that at a later time there. But I'm assuming SEC is still on the front of all these changes and things like that, and they adapt really quick for evolving challenges, right? Maybe we could talk through ESGs and things like that, Nora.
That's a great example, Jay. I mean, I think the SEC is trying to deal with some new focus areas like what you said, ESG, the environmental, social, and governance disclosures, very challenging to implement, and then how companies can actually address sustainability and then the social responsibilities.
Yeah, I'm assuming that's going to change over the next 4 years. I think there's going to be a significant changes in that perspective there. But let's bring it to the current date. How does SEC operate today? What are the challenges they're tackling? How are they working on? Nara?
I think that's a great question. And so while the SEC's role has evolved over the last many years, its core mission continues to be to protect investors, maintaining fair markets, and then facilitating capital formation, which continues as it started in 1929 in the early 30s. It oversees not only public companies and stock exchanges, but also emerging areas like, as we know, cryptocurrencies and ESG that we just mentioned. And then the enforcement, of course, remains the very important part of their work, holding companies and individuals accountable when those rules are broken. We've talked about a couple pretty good examples today, I thought, Jay, where the SEC is very much active in today's business environment.
Right. We spoke about FCPA and so many other different things. What sort of consequences these companies have, and what the executives and the companies when something like this has happened and you're breaking in the SEC's norm?
Yeah, I mean, in the Adani case, of course, the FCPA violation is just alleged at this time. There's nothing proven. But if a company like Adani is found to be liable, that they did in fact break the rules, the consequences could be pretty significant, especially where it undermines investor confidence and distorts the markets, which we didn't want from the 1929s.
Nice.
So you talked about some of the consequences. So the penalties can be pretty severe once a group, company, or individuals are found liable. So it would be typically fines, heavy dollar value fines, permanent bans from serving as officers or directors of public companies, and even in the worst case scenarios, criminal charges, depending upon how the DOJ is involved.
Yes, in the Enron or WorldCom examples, right? Yeah, absolutely.
Yeah.
So
Yeah.
it's not about just punishing them. It's about sending a message to the broader market that there's a lot at stake.
That's exactly right. It really isn't just the dollar value. It is to send messages to the broader market for sure.
Yeah, absolutely. And for companies and professionals who are listening in, what sort of advice would you give, Norm, in terms of avoiding these pitfalls, given you have so many years of experience in this area?
Well, you have a lot of experience in this area too. But I think first of all, it's really for companies to actively monitor their financial transactions and third-party relationships. I think the Macy's example that we just talked about earlier is pretty relevant here. Secondly, it's really to foster a culture of integrity at all levels of the organization. And that's basically honesty and truthfulness and transparency. And then thirdly, it's to invest in technology solutions, which I know you're very familiar with, as an expert NetSuite implementer, and how these systems help provide controls. So these technological solutions can make it easier to maintain accurate records and then hopefully identify red flags before they become too huge or too problematic. Like the Macy's examples.
Awesome.
So these tools are game changers, and we can definitely talk more about those in future episodes.
No, thank you. Thank you for, this initial episode. It's been great. Cases like these, which we spoke about, and issues that we spoke about are still relevant today as it was in 1934, right? And
That's exactly right. And Jay, thank you for being here with me today. And for our listeners, I just wanted to say transparency and integrity aren't just compliance issues, but they are competitive advantages. And so in our next topic episode, we'll be talking with Jay about some of the key laws passed since 1934, which are very much relevant today, including some additional examples for what you heard today. So that's it for today's episode of Reporting Norms. If you enjoyed this discussion, don't forget to subscribe, leave a review, share with your colleagues. So if you have any questions or suggestions, future topics, please definitely reach out to us. Until next time, everyone, stay transparent.
take care.